Well, good day, traders. Chris Weston here once again, giving you a run through of all things global markets. We're keeping a keen eye on really on the centerfold, which is the currency markets here, having a look at what is likely to drive the sort of event risks and landmines that we once again have to put our portfolios through, and the expected moves based on implied volatility, risk reversals, and some of the other sort of unique factors that we look at in the week ahead video here. But certainly let's go straight to the board to give an understanding about what's really driving things at the moment, the sort of performance moves we've been seeing. I've had a look at this Bloomberg chart and the performance of currencies against the euro. Why have I chosen the euro? Because the euro is getting absolutely battered from pillar to post. People say, Chris, it's oversold. Yeah, I don't disagree with that comment whatsoever. But if you have a look at the moves, it's really been euro pound, which has been the performer this week. If you've been short euro against the quid, you're making 2.2%. But it's the Mexican peso which I think is really fascinating, because we'll go into that in a little second, because carry has been so much in vogue. You're using the euro as your funding currency. Okay, fine, there's been some weakness in some of the data points. Industrial production, one. We'll talk about the event risk that's going to come up in the new week. But certainly the euro is that predominant funding currency, and yeah, people have been in things like the rupiah, people have been in the Mexican peso, in the major currencies there, and also in the SAFA as well, which has been doing well against the euro. Euro dollar's been the one where all our flow has been. It's not going to surprise anyone too much, to be honest. You know, it's the most traded currency pair, everyone knows that. But euro dollar has been the one that really people have been focusing on. We've seen a mixture of two-way flow. I think that's probably over the last 24 hours. People have potentially saying that elastic band's pulled a little bit too far, but we'll talk a little bit about euro dollar at the moment. The only currency which hasn't necessarily fallen too much has been the Danish crown, but no one really ever trades that one, to be honest. Brazilian real's had its own issues at the moment, but really when you're looking at the weak link in G10 and across the major currency spectrum, it's really been the euro, which again reinforced the idea that the data points haven't been great. We've been looking at what's happening in China. And okay, last sort of 24 hours, there's been a few increased concerns once again, given the change to methodology by which people are being diagnosed with the coronavirus there. So that those numbers have obviously spiked up. We've seen a little bit of a move in dollar CNH, nothing too spectacular, but people are obviously concerned that ramification is going to spill through into the German economy at the moment. But it really is all about selling euros, and you can see the performance there, one against the pound, where we've seen a change of guard at the Chancellor with Javid step down, and the idea is that he's going to be replaced by someone who's a bit less fiscally prudent and willing to splash the cash effectively, and I think the pound's had a bit of a rally on the back of that. But before we get into the event risk and the potential fundamental catalyst for the week ahead, let's go straight into what the market's expected for moves. And you can see here on my volatility matrix, we've got some of the sort of major currencies that we see quite a lot of flow in. In the realised vol, which a lot of people will be using for risk management, you're going to look at things like the average true range, the 5-day average true range, and use that as a guide to understand how far away your stop loss should be. And Bollinger Band's obviously a representation of those two standard deviation vols from the 20-day moving average. You can see those range there. But I want to take it to the middle column, where you can look at 1 month at the money implied volatility, 1 week at the money implied volatility. It maintains this Aussie yen, still very much the one where if you want moves, expected moves, Aussie yen's the place to be. But then again, we put context on where the 9.22 annualized rate is, so we break that down into a week. That's 45 percentile. So it has crept up a little bit of late, but it's still not at levels where I'd be too concerned. At 45 percentile, it's not really too much. But the Aussie yen, based on the straddle pricing, is expected to move 80 pips up or down, so that puts it on a range of 74.56, 72.96. Have a look at euro dollar. That implied volatility is 4.77 on 1 week. That's the 32nd percentile. Now that has moved up a little bit. We're going to go into a chart in a moment about what's happening in implied volatility there, but it's not going to surprise anyone. Volatility is directionally agnostic, so we can get higher volatility when price is going down, but also when price is going up as well. But the market in the week ahead, knowing all the data that we know and all the sort of known knowns, is expecting euro dollar to price up or down 61 pips with a 68.2% level of confidence. We obviously can take that outlier out and use things like 10 delta strangles and various factors, but I'm just using a straddle price, and the market is saying we expect euro dollar to trade 109.01 down to 107.79 with a 68.2% level of confidence. Dollar yen as well, 26 percentile in terms of that 1 week vol, 1.6%. That gives it a 59 point move up or down, 110.40, 109. 22 there. If you have a look at the JP Morgan Global FX Vol Index, which sort of aggregates all that, we're trading 5.53, which is the 11th percentile. The VIX had a good week this week. In terms of equity markets, we've seen equity markets being buoyed up. We've seen, obviously, the concern or the issue here is we've seen lower bond yields. That's been very good for the net present value of equities in terms of the discounting there. If you didn't see my equity video that I put out yesterday, do have a look in the description. You'll be able to look at there. I've focused on all the reasons why we are where we are in terms of equity land. Oil and gold vol are still pretty low at the moment, so there's no really been pickup. But yeah, vols are pretty low. It's I think euro dollar's the one that's interesting. We're still at 4.77 on the 1 week. It's moved up a little bit, and dollar CAD as well. 23rd percentile of that 12-month range at 3.83. That's the lowest one there. That's the least exciting pair in the market's eyes of these currencies that I've looked at. In terms of rates, let's go into the rate expectations and how we're positioned in rates. I think this is really interesting before we talk about the fundamental catalyst, just to see what's been going on there. Now, despite the fact that we've got equity markets at all-time highs, we've got fairly subdued volatility through, and very obviously very high barriers to see rate cuts coming through. There is a slight easing bias in the mind's eyes. If you go to that far right column, you can see the Bank of Canada is pricing in 30 basis points of cuts, so just over one rate cut over the coming 12 months. Bank of England, now it's moved up a little bit recently, but we're pricing in about 21 basis points of cuts. The Fed, we always look at the Fed, of course. They're considered to be the most dovish central bank in terms of who's going to cut and be the most aggressive over the coming 12 months. 37 basis points, so we're talking about sort of 1.3, 1.4 cuts coming through over the next coming 12 months. The Reserve Bank of Australia, we've heard a raft of different speakers, including from the governor himself. It's obvious that the barriers to cutting rates further from here are very, very high. He's not too concerned about getting to inflation and their target anytime soon. Of course, they've seen some of the rate expectations coming out of the market, 28 basis points, so just one rate cut just being priced over the coming 12 months. And the RBNZ, after everything that we've heard recently, which caused a little bit of a spike up in the Kiwi, 11 basis points. Now, in terms of the next central bank meeting, which you can see those dates there, they are correct this week. The probability of a rate cut, really it's the Japanese central bank there, the Bank of Japan, which is giving a sort of a 1 in 4 chance of a rate cut. It doesn't seem we're going to get that. I'll probably be looking at a rates trade on the back of that, but certainly you can see that the upcoming central bank meetings are fairly lowball. To get those implied probabilities of a rate cut or action from these central banks at the next coming meeting, clearly we're going to need to see a massive tightening of financial conditions. We're going to have to see some of this data coming in much worse, but it's really not going to be particularly exciting there. The Bank of Japan really giving us probably the highest percentage chance, but the Bank of Japan aren't really going to cut rates anytime soon. Now, in terms of positioning, I am saying this before the Commitment of Traders report comes out in the upcoming session, and these numbers will be revised, but you can see there in the second from left column the net position there. It's the euro which stands out to me. 75,000 net short contracts held by non-commercials on euro. That was a bit of a change last week, down 16,000 contracts, so that was an additional short position that was put on. But even at 75,000, if we're just using this as positioning, of course there's other various factors that we can use, and investment banks will look at flow and other factors from different players within the market there. But 75,000 net short contracts is only the 41st percentile of that 12-month range, so it's not particularly stretched even at these levels. When you're talking about stretch levels, you're talking about euro dollar futures. The market's obviously very long there. Gold as well, 79 percentile. That's come down a little bit recently. Those net long gold positions have come down to a slightly more neutral setting. But in terms of pound, 86 percentile, the market's net long there, 12,000. If you're using the futures report there, just to understand a little bit about sentiment. And I think, Australia as well, we've got the net short positions held on the Aussie dollar, 42,000. That's mid-range of the 12-month range as well. But it's euro, which people have been saying to me, we're oversold and positioning's got stretched. Well, if we're just using Commitment of Traders on isolation, which, is one factor of many, the market is still not particularly short in that capacity. Now, we go back to what I was talking about there a minute ago about how people have been using carry. In this environment where we've seen high yield credit spreads narrow against investment grade, we've seen low implied volatility coming through financial markets, you've seen real bond yields fairly low and well anchored, and you've obviously seen equity markets pushing to all-time highs. What you've seen, and you can see from this chart, is the green line, which I've looked at the Deutsche Bank G10 carry basket. I could have a look at the Bloomberg carry index, which is trading at 12-month highs pretty much. But people have been wanting to get paid in this market, and effectively, you're basically going out and funding it using the Swiss franc, or in this case the euro, and you've been looking to go out and get those high beta and high yielding currencies, mainly in the EM space, with Indonesian rupiah doing very well, and of course the dollar doing quite well in G10. And you can see that the dollar index, which is the sort of candlestick chart there, has been sort of moving progressively higher. A lot of that is down to the fact that you've seen the euro under so much pressure there, that's caused that strong trend. But carry there, as you can see in that green line, has got a bit of a push up. It's up about 1% in terms of that basket for the week. And we're going back to euro dollar because, again, as I say, this has caught so much attention. The chart that we've looked at here is the fact that euro dollar has pushed through that 76.4% retracement level of the 2016 to 2018 rally. One suspects now that we're talking about this, do we get a higher probability of coming down to 105, this sort of shaded area, into the sort of low levels that we saw from 2016? That's the question that a lot of people are asking. Rallies are to be sold in this pair. The daily chart of euro mex looks even better in my opinion. We talked about euro sterling. We've got our eyes firmly on what's going to happen if we can push down into those recent lows as well. In euro sterling, do we get a break of that level there? In terms of what's been driving it from a data point, it's not just all carry. Have a look at this chart here, where you can see the white line is the relative differential of the European Surprise Index, Citigroup's European Economic Surprise, relative to the US Economic Surprise Index. These economic surprise indices, effectively, are they going up if the actual data that we see comes out better than what the consensus is doing. So if you see one of those index going firmly up, it shows that the data is consistently beating. So what we're doing is we're looking to look at the European Surprise Index. We're subtracting the US Surprise Index, and you can see that's been moving sharply lower. So we have seen a relative outperformance in the US relative to for Europe of how data's coming out relative to expectations. And you can see there has been a correlation. Maybe it's correlation and causation. Maybe I'm just looking at this and trying to find reasons. But for me, there doesn't seem any doubt. There seems no doubt that part of the reason we've seen this weakness has not just been because of carry, but because the data in the US has been so much better than what we've been seeing in Europe. Have a look at what's going on in the options market. As you can see in the bottom pane, you can see how markets are preferred in terms of risk reversals. These is people looking at the skew of puts to calls, and in terms of the volatility there, we're basically taking the call implied volatility for 1 month in euro dollar, and we're subtracting it against the implied volatility percentage terms for put options in euro dollar, and you can see now that implied volatility is becoming much more skewed to put. So the options market is definitely skewed towards put volatility. People are buying that downside either for protection purposes or for actual speculation, but you can see that on a relative basis that the implied volatility for puts is now outweighing calls by the highest amount really since October. So the market, you can clearly see, is paying up for that downside. In terms of the top one, well, what I've done is looked at the difference between 1 month implied volatility in the white line relative to longer term implied volatility in 1 year, and you can see that 1 month implied volatility is moving up relative to longer term volatility. That's usually quite bad for a spot price. For me, when I'm looking at how I can use the options markets to trade the underlying spot markets, you can see there that what I like is risk reversals. It tells you a lot about semantics. It tells us that the options market sees downside. That's not going to necessarily surprise anyone, but what we also like to see is how people are paying up for near-term volatility relative to longer-term vols, and we can see that that's moving up quite sharply as well. That's usually a negative sign. Dollar CAD, people have been focused on the 133 handle. If we focus on what's happening in WTI, I think it's been interesting to see that inverse correlation with US crude has been ramping up in terms of dollar CAD. We've seen a good amount of flow coming through in dollar CAD up, especially into 132, 150, up until the sort of 133 levels. There's been interest to leave orders into there. But you can see that bottom pane now, the 20-day rolling correlation is picked up to negative spot 60. So effectively you're saying with that rolling correlation that 60% of the variance in dollar CAD has been explained by crude, and that's been increasing. Crude prices have stabilised, and I think that's part of the reason why we've seen the Canadian dollar start to outperform. Euro CAD obviously has been a big trade as well. That's now trading at the lowest level since 2017. If that crude price is going to stabilise here, we are looking firmly at what happens in CAD. And then we go to the Aussie dollar chart. It's one I've been talked about, focused on for a long time, and that's really what's happening into that 67 handle. That is rock solid support, and the interest rate markets there that I talked about have repriced themselves a little bit. I think people have started to roll off those coronavirus hedges that we've been seeing, although the last sort of 24 hours where they've changed that methodology has seen a little bit of speculation that we could see a renewed downside. Until those bids are eaten up and actually see the market really closing on a weekly basis through that 67 in Aussie dollar against the greenback, we're still going to probably likely to chop around. So let's get back to fundamentals and have a look at what's going to come up throughout the week. And I am going to say this before US retail sales numbers come out. But in terms of the US, there's not a huge amount to really focus on. We're keeping our eye firmly on what's happening in the dollar, of course, and some of the Fed speakers that will be coming out this week. But in terms of that, I think that the prospect of a rate cut coming through in the next few months is going to be driven by financial conditions, and a rapid tightening of financial conditions would be the reason the rates market will respond. But there's not a lot to really focus on for this week. We've got building approvals, we've got housing starts, we've got permits. There's not anything that I expect to cause too much in the way of volatility. In Australia, I think that there is some data points which I think you absolutely have to look at. We talked about that 67 cent level, and we talked about the implied vol in Aussie dollar being fairly low, but we've got the Westpac leading index. I don't expect that necessarily to cause too much ramifications. What is interesting would be the wage numbers. We're expecting them to be pretty weak, around sort of 2.2, maybe 2.3% on the fourth quarter. But it's the Aussie jobs numbers on Thursday which will get the lion's share of attention, because the RBA have told us categorically that they're not going to cut rates unless we did see some moves higher in the unemployment rate, perhaps up to 5.2, maybe 5.3% would be that trigger, up from where it is at the moment, 5.1%. So if we do see a weak number, and there's no suggestions that's going to be the case, because the trend has been, whether you're looking at 3, 6 or 12 month, has been for some solid job creation. But the RBA have told us that one of the most important, if not the most important part of their setting policy at the moment is what's happening in the labour market. That's something that we will be watching there as well. And of course, we do get weak numbers. We're going to see the Aussie dollar come down and test that 67 cent level. In Canada, we've got CPI numbers. They come out on Thursday. I think the market's expecting that to go from 2.2 to 2.4%. You've got retail sales numbers on Friday. Europe, we talked about the euro. I've talked about it quite profusely there. Go midweek, and we're looking really at those German manufacturers. Throughout the week, we're watching those German ISM manufacturing numbers, the PMI numbers there. They are going to be absolutely key now. If we talk about the reinforcement of Europe being a funding currency, and that those data points being a bit weak on the session, that German and Eurozone manufacturing numbers I think are going to be absolutely key. That's probably going to be one of the highlights from the week as well. And in terms of retail sales numbers, they'll be CPI numbers. They'll be coming out later in the week, but the market probably will be less of a focus on there. We've also got our eyes on some of the UK data. We've seen a re-emergence of the pound being a bullish sort of situation. People have been focused on covering those shorts in the pound after a bit of a topsy-turvy couple of weeks, and looking to go long specifically against euro, as I say. But we've got jobs numbers coming through in there, retail sales and inflation data to focus on. So there's certainly a lot to focus on throughout the week, and we've got our eyes set up on those charts there. Will we continue to see US dollar flows? Will we continue to see the market looking to apply carry? What's going to happen implied vol, I think, will be the key there.